We want to thank you again for tuning in to our Retirement Education Center YouTube channel, where on this channel we believe in providing you unbiased advice to help you maximize all of your retirement income. Now, of course, on our channel, we do not believe in providing you any type of silver bullet strategies, and we certainly do not glorify any type of one product. But what we do believe in are holistic concepts that would help you retire with confidence. So today, what we're going to be looking out for are those individuals who are going to be retiring in the next 5 to maybe 10 years, even 15 years, what we consider that red zone of retiring, okay? Now, when you're in that red zone, you have to start preparing yourself for some of the things that you may be facing when you actually retire. And one of the major things that you are going to be up against are taxes, right, Andrea?
Right.
They can't be avoided, but they can be mitigated or maybe sidestepped in some way if you are intentional about the planning around those type of taxes when you are actually in retirement. So there are 3 major tax traps that we're going to talk about today that you're going to want to avoid or at least try to mitigate. And so if you're in that red zone of retiring, then you're definitely going to want to stay locked in today. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea Graves, Director of Operations at the Retirement Education Center. And we want to thank you for tuning in to our Retirement Education Concepts videos. These videos were created to help to make the difficult and confusing retirement process simple.
Absolutely, Andrea, because with so many retirement concepts out there, so many retirement strategies, and of course so many retirement products, it can become very difficult for consumers to digest it all. That is why we're so fortunate that we work with a team of expert advisors to help us build a retirement roadmap that will let our clients know when, where, and how they can reach their retirement goals.
For additional concepts on how to maximize your retirement, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos. So Carson, more people are going to be retiring within the next 15 years, and this will be the most retired people that we've had in the history of our country. So we know that certain tax traps can't be avoided, but you believe that we can at least plan to avoid some tax traps, right?
Yeah, and I think that's really the case, Andrea, and this is really, noteworthy. According to the Census Bureau, by 2030, for the first time in the U.S., we're actually going to have more adults that are 65 and older than we have children under the age of 18 in this country. Imagine that. So with that being said, we know that our national debt is also over $30 trillion right now. If you're talking about $30 trillion in debt, you're no doubt talking about at some point, all of these retirees are going to be facing probably maybe some increase in taxation as well down the road. And so you have to prepare for that in some form or fashion. We never know what the future holds, but we do know what the present is. And so if you can actually plan in the present for what may take place in the future, you at least equip yourself to be better prepared if there are going to be tax increases. And I can tell you, with $30 trillion or more in debt, there's no doubt that Uncle Sam is going to try to figure out ways to increase taxation and get those taxes faster from us. And so that's what we're going to be talking about today, Andrea. But before we get into these 3 traps, there are 2 rules that we always like to give you. And what are those 2 rules?
Well, rule number 1 is to never run out of money, and rule number 2 is to never forget rule number 1.
All right, so let's go ahead and talk about 3 major retirement tax traps that you're going to want to try to avoid.
All right, Carson, so tax trap number 1 are RMDs, which are also required minimum distributions. So could you tell us more about that?
Yeah, RMDs, or better known as required minimum distributions, is a tax trap that you're going to want to try to at least avoid or minimize for yourself. Now, we understand that there are numerous ways in which the government can extract taxes from us. And the thing about it is that they can always move that goalpost at any time, Andrea. And so it can leave you in a predicament if you're not prepared for this situation. One of those goalposts has been the Secure Act. We've talked about this on prior videos, where the Secure Act now has it to where you can no longer pass down your IRA to your beneficiaries and allow them to stretch that over their life expectancy if it's not a spouse. So that's one of the things that you're looking at. You have to have that money out of those IRAs within 10 years, which of course is going to allow Uncle Sam to get those taxes on those pre-qualified dollars, money that hasn't been taxable, very, very soon, within 10 years. So with that being said, you have to understand that these are some of the things that can happen to you within your retirement that you have to be prepared for. Another tax trap when it comes to RMDs is that, yes, with the Secure Act, they did make some changes there. Now you don't have to take those required minimum distributions at age 70 and a half. You can now wait until age 72. And with the Secure Act 2.0, in which we also discussed on a prior video, Andrea, we know that age could possibly be moved back to age 75. But with all of that being said, you will at some point during your retirement years have to take out required minimum distributions from those retirement accounts. And if you do not, you will be hit with a 50% tax on those funds, because they did not come out. More or less like a 50% penalty, along with the taxation at your ordinary income tax bracket. So just imagine, Andrew, if someone is sitting in the 20% tax bracket and they forgot to take out the required minimum distribution, we're talking about 70% of your money being hit with a tax penalty. So it is critical that you're working with an advisor who can help you understand that it is time for you to take your required minimum distributions in order for you not to be hit with a 50% tax hit on those dollars, along with the ordinary income tax that you're going to have to pay on those funds as well.
All right. Well, Carson, what are some strategies or steps that retirees can take to minimize the RMD trap?
Yeah, one that comes to mind very clearly for me, Andrea, and what I try to help my clients do is actually do Roth IRAs. Now, we know there are two ways in which you can actually contribute to a Roth. Now, some people may make too much money, Andrea, and they cannot contribute to a Roth IRA. So what we literally let them do is put money into an IRA, what we call a non-deductible IRA, and we have them to convert that into a Roth IRA, which is known as a backdoor Roth. So that's one of the strategies you can do if you make too much money. But if you're actually in the income bracket that can contribute to a Roth IRA, or if you have an option in your 401k plans that has a Roth 401k option, we highly encourage our clients to contribute to those type of accounts. Because why? When you put money into a Roth IRA, yes, it's after tax dollars, but here's the secret sauce to that. That money will come out tax free on the back end. And also to note, Andrew, when that money is coming out of a Roth IRA, it's not mandatory. That means you're deciding when to take the money out of those accounts, because they do not have a required minimum distribution requirement. So those dollars can literally sit into those accounts into perpetuity, or until you pass them on into your estate. And yes, Andrea, according to the Secure Act that's in place right now, you still do have to take those dollars out of that Roth account within 10 years if you're not a spouse of that beneficiary. But guess what? That money then will be coming out tax-free to the estate. So you've conquered two goals there. You've eliminated the RMDs for yourself, and you've also taken the tax burden from your beneficiaries because you've actually contributed to a Roth account. So Andrew, this is a very simple and easy way in which a person can sidestep the required minimum distribution trap by just opening up a Roth IRA and then allowing that to be your retirement savings, as opposed to an IRA in which you're going to be required to take those RMDs.
All right, Carson. So tax trap number 2 is Social Security and provisional income. How or what ways can we avoid this tax trap?
So Andrew, this is really one of my high points that I try to talk to my clients about when it comes to trying to minimize taxation on their retirement income. Social Security, for the most part, was never meant to be taxable, by the way. That came along later down the line in the 1980s. But with that being said, Social Security in this day and time still may not be taxable until you hit a certain provisional income level. Now, if you are a single person, that income level is between $25,000 to $34,000, in which anywhere from 50% and over that $34,000 mark up to 85% of your Social Security benefits may become taxable. Okay, now if you're married, it's different. It's a different threshold for the provisional income, $32,000 to $44,000 of provisional income, in which your Social Security benefits will become taxable anywhere from 50 to 85%. So the big key is, how do you avoid this provisional income trap? What is provisional income? First and foremost, that's any income that you receive. That's your wages that you're earning. That may be dividends that you're receiving off of your non-qualified accounts or your capital gains that you may receive. It can be royalty income. It can be any type of income. Even your tax-free income from municipal bonds can be included into your provisional income plus 1/2 of your Social Security benefits. But here's what's not included in your provisional income, Andrew: Roth IRAs. So we talked about this in the RMD strategy, but lo and behold, having a Roth IRA can actually help you minimize the taxation on your Social Security benefits, because if you can replace your income that you may have to take from your RMDs from a qualified account like an IRA, which is going to be taxable and included in your provisional income, you can actually implement a Roth IRA in this situation, Andrew, and that money will be, 1, tax-free coming out, and 2, not included in your provisional income. Therefore, if you're close, we can either help people eliminate taxation from their Social Security benefits altogether, or at least minimize the taxation on those benefits. So that's just one thing that I believe you should be thinking about if you're trying to avoid being taxed on your Social Security benefits.
All right, Carson, so tax trap number 3. Medicare. Anyone that's turning 65 will apply for Medicare, most likely. So how can we avoid any tax traps on Medicare?
Yeah, just like your Social Security benefits, Andrew, Medicare has a nice little surprise for you too, known as income related monthly adjustment amount, or better known as IRMAA taxes. Okay, now when it comes to your Part B and Part D of your Medicare premiums, they are going to base what you're going to pay off of the income that you're receiving on an annual basis. And this is very important, because guess what? If you're receiving income from your IRAs, you're receiving income from those RMDs, or if you're actually converting your IRAs to a Roth IRA at a non-timely manner, Andrea, they are going to look back 2 years and see what your income was, and they're going to base your Medicare Part B and your Medicare Part D off of that income. So I want you to take a look at this chart that we're going to put up on the screen, just so you can see how dramatic of an increase it could be if you do not time either your Roth conversions properly, or if you're not aware of how your income is going to impact what you're going to be paying on your Part B and or Part D Medicare premiums. Take a look at this chart that we have on the screen here. As you can see on the chart, for individual, Andrea, if you are making $91,000 or less, this is in 2022. Now this changes every year, but if you're making $91,000 or less, you will only be paying $170 per month for your Part B premiums. Okay, if you look at a joint income at $182,000 or less, you're going to be paying $170. But let's just say you converted, you're at the $80,000 mark of income, but you decided to convert $25,000 from your IRA into a Roth by the suggestion of your advisor, which may not be a bad idea, but that's just maybe something that you wanted to do at that time. Well, look what happens when it pushes you into the higher tax bracket between $91,000 and $114,000. You would literally be paying $238 per month for your Part B premium. That is a substantial increase. And of course, the same holds true for joint income of $182,000 or more. You'll be paying $238 per month if you do not plan your strategies properly in retirement. Now, here's the thing. You can ask for a repeal. You can have some life-changing events that you can make note of to actually request that they take a look at that and make note that you've had these changes. So you can repeal that income that they actually are saying that you made 2 years ago. Maybe you got a divorce. Obviously, maybe you got fired or you stopped working, and that can be one of the things that you can make note of and say, hey, that was my income then, but this is my income now. I need to be paying the lower premium. So you can do that, but by all means, if we can avoid appealing anything to the government, we would like to do so. And that's why proper strategies will be important for you in order to avoid these types of traps that's coming your way.
Well, Carson, that was some really important information that I think retirees should make note of. So thank you for your insight on that. And thank you for watching. And if you felt that this video was beneficial for you, please like and share with others.
So I really do hope that the information that we shared today will be beneficial for those of you who are in the retirement red zone and really trying to avoid the tax traps that may be coming your way. Please remember that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for a fiduciary financial advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in the description below and go ahead and schedule a 1-hour free consultation with us today.
For more information about this topic or any of the other topics that we've shared in our other videos, feel free to reach out to our office or leave any questions or comments in the section below. After this video, please check out our other videos that we've created that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.